Welcome trade pros to this weekend's video, which we are going to take a quick peek at the opening range, how we like to utilize the opening range in our day trading strategy, a couple of tips and pointers on how you can implement this in your strategy as well. So let's get at it. All right, traders, so what you guys see in front of you is the 5-tick chart here for the Dow futures, and these lines in front of you are the opening range. So you got the opening range low and you've got the opening range high, and what this is simply a strategy that used to be used in the pit, and what they did was they would essentially track the high and low of the opening range. So opening range can be something as low as the first 30 seconds of the market open. What we like to use is the first 5 minutes of the market open. However, you can kind of play around with these settings and see which one works best for you. We found that the 5-minute works best for us, but like I said, you can go down as low as 30 seconds, 1 minute, up to as high as 15 minutes or the first 30 minutes of trading. Granted, the longer term trader that you are, example, if you are a swing trader, you might look for the first 30 minutes or the first 60 minutes. However, as day traders, we like to take a look at the first 5 minutes. That gives us a pretty good idea of the high and low for the session, and we can now go into what you can use the opening range for. So in this case, this was a bit of a trending day, and how we kind of figured that out was that usually what happens on a trending day for the opening range is that you'll have one side of the range trade. And in this case, we had the first 5 minutes, we had a low printed just above 25,375, and this high printed at 25,421. So that was right here, and this cutoff right there was the first 5 minutes. And after the first 5 minutes, what we saw was a press lower down into the open, and we saw the buyers support that open and press back up into that opening range. So the opening range high can be seen as resistance and support, and it is also used as a means to kind of track what sentiment is throughout the session. So you can use it as a buy filter, sell filter, meaning that if the market is above the opening range high, you can look to be taking longs. Vice versa for shorts. If the market is below the opening range low, you can look to be on the short side. You can also use it as support and resistance. So as you saw in this example here, it formed that resistance here. We had a test of it and we saw the sellers press. Then we saw the buyers move this thing higher, and we held several rotations here at the opening range high. There's 1, 2, 3 tests before we ripped up higher. And so that's one of the ways you can look to qualify a trade based on that opening range is, we have made that opening range, we've held the open twice, we're back at the highs, this thing is looking bullish. Look to long this thing on a breakout and rotations that hold that level for a press higher. Alternatively, what you can do is kind of use it as a mean regression trade. So if we come up here and you see the market kind of traded higher and then sells all the way off, what you can look to do is you can sell the retest of that opening range high on a breakdown. So here you can see we had move up, support, and a press higher, and then the market sold off back into that level, bounced off, broke below it, and then retested that level once and twice before ultimately pressing back down to the lower end of that range. So another opportunity you can have on the short side here is if the market breaks above that high and then comes back into that level, breaks below it, you can look to short some rotations as resistance here for a press to the downside of that range. And so in this case, that's what we're looking for. The market didn't quite press down into that opening range low and instead found a bid, and look at where it held some resistance. It found resistance again around the opening range high. And so we had 1 rotation, 2 rotations, 3 rotations, then we broke back above it, and now you can see 1, 2, 3 times holding as support, a little bit of a press higher, and then we came back to it again once more, and that was really the final kiss of death before the buyer stepped in and really drove this thing higher. And so that is how we like to use the opening range in our trading as day traders. We like to use it for a sentiment indicator as well as support and resistance. One of the things as well is that if the market breaks out to one side of that opening range, fails back within that range, holds it as support, comes back into the other end of that, and then breaks that level and rotates back into it, that will likely lead to a range bound day. So if you see that kind of price action happening in around the first 15 to first 30 minutes of the session, you can be pretty sure that you're going to have not a trending day, a range bound day. Until the market can break back above those levels, you're likely going to be in a range. So you're not going to be looking for trending strategies. You're going to be looking to trade range bound strategies, i.e. trading the extremes of the range, and you've got a pretty good reference as to where those extremes might come in. So I hope that helped you guys. That is how we like to use the opening range in our strategy. If you guys are using the opening range currently and you guys have some good feedback, please do share those in the comment section. How do you guys use the opening range in your trading strategy? So that's going to be it for this weekend's video. Until next time, guys, good luck and good trading. This is Mark from TRADEPRO Academy signing off. Take care, guys.